You may start, sir.
Okay, thank you. So, dear student, I welcome you all in this another session on corporate financial reporting under the online coaching, online live coaching system classes offered for the CMS students. Now, if you have already attended my previous two sessions, then you are already have come. Okay. So,
Any problem, sir?
হ্যাঁ আমি ওই আগের মানে যেটা অলরেডি বলছি সেটা শুনতে পেলাম কেন হঠাৎ করে?
শোনা যাচ্ছে
রে
তো।
হ্যাঁ,
আপনি
না
একবার চুপ
রেকর্ডেড
হয়ে গেলেন।
যেটা অলরেডি রেকর্ডেড সেটা আমি আবার এক্ষুনি শুনতে পাচ্ছি সেজন্য বললাম।
আচ্ছা, আচ্ছা।
কন্টিনিউ করব?
কন্টিনিউ করুন। আপনার কনটেন্টটা স্যার ক্লিয়ার নেই। মানে স্ক্রিনটাই চলে আসছে
না
কনটেন্টের
স্ক্রিনটা
মধ্যে।
আমি আনিনি। এখন আমি আনিনি।
আচ্ছা, আচ্ছা। তাহলে আপনি কন্টিনিউ করুন।
ওকে ঠিক আছে আমি শুরু করছি। ওকে। Okay, so dear students, let me welcome you all in the yet another session on corporate financial reporting, paper 18, under the online live coaching classes for CMS students. And if you have already attended my previous two classes, then you are already aware that in those two classes, on those two sessions, we have discussed about consolidated financial statement. Dear students, I welcome you all to this yet another session on corporate financial reporting, paper 18, under online live coaching classes for CMS students. And today's our topic will be business combination. Now, if you have already attended my previous two classes, then you are well aware that in those two classes, I have discussed about consolidated financial statement. বলছিলাম, মানে এর থেকেই বলছিলাম, হেডফোন থেকেই বলছিলাম। এক মিনিট, এক মিনিট, এক মিনিট। হ্যাঁ, এখন এখন শোনা যাচ্ছে? এখন কিন্তু আমি হেডফোন ইউজ করেই কথা বলছি। মোবাইলটা রয়েছে আর হেডফোন ইউজ করছি। ওখানে, ওখানে কি দেখাচ্ছে? এটাকে? আচ্ছা। এবার দাঁড়ান, এবার আমি এতে বলি, মাইকে বলি। হ্যাঁ, এবার শোনা যাচ্ছে? হ্যালো? এটা এটা ওই এতে Teams এ শোনা যাচ্ছে এটা? আচ্ছা, ঠিক আছে। দেখা যাক তাহলে। এবার আমি ১ম থেকে আবার শুরু করছি তাহলে, হ্যাঁ? হ্যাঁ, ঠিক আছে। ১ম থেকে। হ্যাঁ, মনে হচ্ছে ঠিক হয়ে গেছে। ওটা ওই একটা বোধহয় কোনো কারণে অন ছিল, সেই জন্য প্রবলেম হচ্ছিল। যদিও আগে কোনোদিন প্রবলেম হতো না। দেখি, আশা করি দেখে নিই। ওকে। হ্যাঁ, শুরু করি আগে। হ্যাঁ, কন্টিনিউ করছি। স্ক্রিনটা শেয়ার করি এটা। কনটেন্টটা শেয়ার করলে না, না, ওটা একটা উইন্ডো শেয়ার করা ছিল। এই ডেস্কটপ। এবার ঠিক আছে। Okay, so dear students, let me welcome you all. Here, desktop at ঠিক আছে. Okay, so dear students, let me welcome you all in this yet another session on corporate financial reporting, paper number 18. And today our topic will be business combination. Under this online live coaching classes for CMA students, today we will be discussing about business combination. Now, if you have already attended my previous two classes, then you are quite aware that in those two classes we have discussed about consolidated financial statement. Now, this consolidated financial statement and the topic that we are going to consider today, they are interlinked, or rather we can say that consolidated financial statement starts with this part, business combination. So we will link those two topic as well in this discussion today. Rather, moreover, business combination not only covers the initial part of the consolidation under a holding subsidiary relationship, but it also covers amalgamation, acquisition. So in that way, business combination, the chapter that we are going to cover today, it will encompass, it will actually provide you an overview of various forms of business combination, not only holding subsidiary relationship. For the point of view of the final examination, this topic is quite important, and you can at least expect one complete question of, say, one complete full comprehensive question from this business combination topic, apart from various small questions which will come as a part of your MCQ questions. Now, let me just consider that PPT. Okay, right. So for this particular topic, I have prepared one PPT, and it will be eventually shared by the institute with you all. And those PPT, this particular PPT will cover the outline of our discussion. And along with this PPT, I will be also using certain additional resources Some questions I will cover, some exercises I will cover right from the study material itself. And in that way, we will try to have a overall understanding about this topic, business combination. Let us start with this slide. Now, business combination in India under the new accounting standard regime, that is the Ind AS regime, all kind of business combination in India are now guided by Ind AS 103, which is known as business combination. Now, if you consider the objectives of this accounting standard Ind AS 103, then the objective of this accounting standard is to improve the relevance, reliability, and comparability of information that a reporting entity provides in its financial statement about a business combination and its effects. So whenever there is a business combination, the reporting entity eventually will report this business combination through certain accounting activities, through certain accounting arrangements, and through that accounting arrangement, or to make that accounting arrangement relevant, reliable, and comparable, to provide certain information which are of use for the users, this accounting standard Ind AS 103 business combination has been designed. Now, under this accounting standards, this business combination, first of all, we need to have a clear understanding of what does it mean. And then we will try to identify the methodology that will be followed in accounting for a business combination. Now, an entity shall determine, in a business combination account situation, an entity shall determine whether a transaction or other event is a business combination. Because unless and until we can identify the particular transaction as a business combination, there is no question of application of this Ind AS 103. So first and foremost, we need to ensure that the transaction that we are going to report is a business combination, and then only Ind AS 103 we will apply. Now, for that purpose, Ind AS 103 will first require you to understand the concept of a business. Now, Ind AS 103 says that the assets acquired and liabilities assumed generally constitute a business. To define the business in an appropriate manner, Ind AS 103 provides that a business is an integrated set of activities and assets that is capable of being conducted and managed for the purpose of providing a return in the form of dividend, lower cost, or other economic benefits directly to the investors or other owners, members, or participants. That is, in other words, normally a set of assets does not necessarily constitute a business until and unless that particular set of asset is further supported by an integrated set of activities. There are certain laborers who are working, there are certain arrangements of machineries, and in that way, it is capable of being conducted and managed with the purpose of providing return. The return may be in form of dividend directly, but not necessarily every company is earning and paying dividend, is giving dividend. So the other objective in with respect to providing a return may be to lower the cost or provide other economic benefit to the investors or other owners. If that is so, that particular set of activities and combination of assets we can call a business. If there is only a set of assets not constituting a business, the reporting will not be done under Ind AS 103 business combination. Rather, the transaction shall be accounted for as asset acquisition, and Ind AS 16 or 38 will apply in such a case. So first of all, we need to just differentiate between an asset acquisition versus a business combination. Asset acquisition is not dealt by Ind AS 103, while business combinations, they will be covered under Ind AS 103. Now, why such distinction is so important? The distinction is so important because in business combination, the assets and liabilities, they are measured at fair value, while in case of asset acquisition, the assets are measured at their carrying amount or cost. Similarly, in case of business combination, the organization may have to recognize some amount of goodwill or gain from business purchase, These two terms I have already discussed in my previous classes, and also I will discuss it again in the eventually in course of the discussion today. In case of asset acquisition, no such recognition of goodwill or gain from business bargain purchase is required. Because of these two main reasons, we need to first differentiate business combination and asset acquisition. Asset acquisitions are accounted by Ind AS 16 or 38, while business combination will come under Ind AS 103. Now, when we have already decided or evaluated a given transaction or an event and have come to the conclusion that it is a business and there is a business combination, then comes the question of accounting. So, having an idea of business, let us now try to identify a business combination transaction. An acquirer might obtain control of an, simply stated, a business combination is actually a particular kind of an event or transaction where investor acquires the control of the investee. Accordingly, an acquirer might obtain control of an acquiree. Acquirer means the investor, acquiree means the investee. So an acquirer or investor might obtain control of an acquiree or investee in a variety of ways. For example, by transferring cash or cash equivalent or other kind of assets, including net assets that constitute a business, by incurring liabilities, by issuing equity interest, or by providing more than one type of consideration, say equity share, preference share, debentures, and so on. Or there is another possibility without transferring the consideration, including by contract alone. Okay, so these are the possible ways through which the investor can obtain the control in the investee, that is the acquiree. When that control is acquired, there is a case of business combination, and that is to be accounted under Ind AS 103. Now comes the question, then how in different ways the business combination can be structured. A business combination may be structured in variety of ways for legal, taxation, or various other reasons, which include but are not limited to the following. For example, one or more businesses become subsidiaries of an acquirer, or the net asset of one or more businesses are legally merged into the acquirer. Say, H Limited acquires 70% voting right in S Limited. Then this is a case where the acquirer, that is H Limited, becomes uh, comes or say controls the acquiree, that is S Limited, by this acquisition of 70% voting right. It is a business combination. Or it may so happen, say A Limited acquires B Limited, and B Limited goes into liquidation, and all the assets liabilities of A Limited, the net assets of B Limited, gets merged with the net assets of the A Limited. This is a case of acquisition. It is also a business combination. There may be a situation where one combining entity transfers its net assets, or its owners transfer their equity interest to another combining entity or to its owner. Say B Limited is transferring its net asset to A Limited, or the owners of B Limited, they have transferred their equity share to the owners of A Limited. In that way, also a business combination may be constituted. Again, there may be a case where all of the combining entities transfer their net assets, or the owners of those entities transfer their equity interest to a newly formed entity. Say, there are two entities, B Limited and C Limited, and B Limited and C Limited both have transferred their net assets to a new company, say A Limited, which was not there, which is newly formed, and thereafter B and C Limited goes into liquidation and A Limited remains. A case of amalgamation. Again, it is also comes under the definition of business combination. Or it may so happen a group of former owners of one of the combining entities obtain control of the combined entity. Say B Limited, C Limited, two entities were there, and when they constituted and merged together to form a new company, under the new company, the management of C Limited becomes the management of the entire combined entity. So that is also a business combination. In this different type of based business combination can be constituted. All this type of business combinations will be covered under Ind AS 103. Now, for the purpose of examination and normal discussion, we generally identify the following three popular type of business combination arrangement, but I have already mentioned that these are only a few type of business combination structure, not necessarily an exhaustive list. So there may be some other type of business combination structures also which will come under this Ind AS 103. The first one that we can identify is a popular holding subsidiary arrangement. That is, a holding company acquiring controlling interest in the subsidiary company. If you can refer to my previous discussion or simply can refer to Ind AS 110, then you will find that it has defined a holding subsidiary arrangement like this: when a company acquires more than 50% voting right of another company, it is one way of becoming the holding company and the other company becomes a subsidiary company. Though there are other forms also where even not by acquiring more than 50% voting right, one company can become a holding company. So whatever be the case, in case of a holding subsidiary arrangement, a holding company acquires the controlling interest in the subsidiary company. And in this case, on the date of acquisition, there is a requirement of preparing a consolidated financial statement. This date of acquisition consolidated financial statements are to be prepared based on the concept of Ind AS 103, that is business combination. So basically, in case of a holding subsidiary arrangement also, on the date of acquisition, the consolidation is done as a business combination under Ind AS 103. Thereafter, however, on all the future reporting dates, consolidated financial statements are also to be prepared till such relationship continues, but it will be guided by Ind AS 110. So basically, in case of holding subsidiary arrangement, date of acquisition consolidation is done under on Ind AS 103, and thereafter, each of the two companies, they will continue to prepare their standalone financial statement, and the holding company will continue to prepare one consolidated financial statement of each type for all the other reporting dates subsequently. There is another popular form of business combination which we normally refer to as acquisition. Now, this acquisition, in case of this acquisition, basically the acquirer gets the control of the acquiree and the acquiree goes into liquidation. The assets and liabilities, or rather say the net assets of the acquiree or investee company, gets legally merged into the acquirer. So thereafter, only acquirer exists, not the acquiree. In this case, this event is also to be considered as a business combination, and it will be recorded as per Ind AS 103. But here, the merged entity is the acquirer only, and therefore in its individual set, that is the standalone accounts, the consolidation will be reflected. There is another popular form of business combination which we call amalgamation, where two or more companies will be merged into a new company, and the previous companies or the old companies will go into liquidation and only the new company will prevail. This is also covered under business combination. Mainly in our today's discussion, we will cover point number 2 and point number 3 in detail, because point number 1 is mainly covered under Ind AS 110 after the date of acquisition, which we have discussed in detail in previous two classes. The notes or the PPTs are also available, and the videos are also available in the Institute of website, so you can refer to those discussions. Now, while we will be covering in detail point number 2 and point number 3, the initial, that is on the date of acquisition, when a holding a subsidiary arrangement takes place, as I have already mentioned, it is covered under Ind AS 103. So those few cases we will cover here also to have a clear understanding how the business combination transaction actually are accounted for. Now, let us come to accounting for business combination. Now, an entity shall account for each business combination by applying the acquisition method. Now, what is this acquisition method? This acquisition method involves certain steps. First of all, this acquisition method requires you to identify the acquirer. So, while accounting for a business combination, under Ind AS 103, we at the very beginning need to identify the acquirer. Now, identifying the acquirer is more or less very simple, because acquirer is the person who is investing in the other company, and the investor in most of the cases is the acquirer, while the investee in most of the cases are the acquiree. In case of a holding subsidiary relationship, therefore, H Limited acquiring the controlling interest in S Limited means H is the acquirer while S is the acquiree. If we consider the uh, acquisition case, say A Limited acquiring B Limited, normally under normal circumstances, because there are certain exceptions, I will come to that. A Limited acquiring B Limited, and A Limited is issuing certain purchase consideration in form of, say, shares or debentures or preference shares to the shareholders of B Limited. In this case, A is the acquirer and B is the acquiree. We can say A is the legal acquirer and B is the legal acquiree, and for accounting purpose also, they are becoming the acquirer and acquiree, though there are certain exceptions. I will come to that. In case of amalgamation, when two companies are going into liquidation and a new company is being formed, here the new company is the acquirer, and the old companies, they are the acquiree or the investee. Again, there are exceptions. I will come to that at the later phase of our discussion. After identifying the acquirer, the next will be to determine the acquisition date. Why it is important? Because in case of an holding subsidiary relationship, on the date of acquisition, one set of consolidated financial statement is to be prepared. And in case of the acquisition or amalgamation cases, on the date of acquisition, the merger will take place. The net assets of the acquiree company will get merged to the acquirer company in a single balance sheet. And therefore, that date of acquisition, identifying the date of acquisition is quite important. How to identify? In case of a holding subsidiary relationship, if the holding company is acquiring the controlling interest of the subsidiary company on a given date, that date is the acquisition date. In case of step acquisition under holding subsidiary relationship, suppose holding company has acquired initially, say, 30% of the share voting right of the acquired of S Limited, while another 40% has been acquired, say, on a subsequent date. So altogether, on the second day, holding company enjoys a cumulative share of 70% of the voting right, and on that day, the control rests with the holding on control rests with the investor. So the second date is actually the date of acquisition. If we take the example, say on 30th June, suppose 2022, H Limited acquired 30% of S Limited, but another on 30th September, another 40% share has been acquired. So it is not 30th June the date of acquisition, because on that date the holding was only for 30%, but on the next day, 30th September, when the cumulative holding becomes 70%, that becomes the date of acquisition. So basically the date of acquisition is 30th September in that given case. In case of acquisition, where entire entity and its net assets are being acquired on a single date, then it is the date on which the net assets of the other company is being acquired by paying the purchase consideration. Similar is the case with amalgamation. So after you have identified the acquirer and accordingly the acquiree and determined the acquisition date, next comes the question of getting the consolidation done. And for that purpose, an important part is recognizing and measuring the identifiable assets acquired and liabilities assumed and any non-controlling interest in the acquiree. What does this say? Now, this has been already discussed previously also in consolidated financial statement, that particular discussion. Still, I will repeat here. Now, when, say, one company is acquiring another company, either through an holding subsidiary relationship or an acquisition or amalgamation case, a consolidation needs to take place. In case of holding subsidiary relationship, consolidation needs to take place on all subsequent reporting date also. And for acquisition or amalgamation, it is to be done on the date of acquisition and not thereafter, because the other company goes into liquidation and only the acquirer remains. Now, this acquirer and the acquiree, they may be following some different accounting standards, accounting treatment. So the figures, the carrying amount of the acquiree, the company that I am acquiring, that particular carrying amount, those particular carrying amounts may not be acceptable to me. There may be differences in accounting treatment, policies, etc., etc. So the acquirer cannot directly merge the figures available from the acquiree in its balance sheet, but it needs to get the fair value of those assets and liabilities identified, and only those fair value of assets and liabilities can be considered for the purpose of consolidation. Accordingly, we need to, under 103, it is said that we need to recognize, means to account for and measure the identifiable assets acquired, liabilities assumed. So whatever assets we are acquiring from the company, or whatever liabilities we are acquiring, or of the in case of holding subsidiary relationship, whatever assets and liabilities the subsidiary company is having, we need to get their fair value. Those values can only be used for the purpose of consolidation. Those values can only be used for the purpose of this merger of the net assets of acquiree in case of acquisition and amalgamation. Now, in case of holding subsidiary relationship, it may so happen that the holding company has acquired less than 100% of the total shares of the subsidiary company. So there remain some outside shareholders, some minority shareholders, which we call, under the new Ind AS regime, non-controlling interest. So not only the acquirees assets, liabilities are to be measured at fair value, but also if we are acquiring less than 100% in case of holding subsidiary relationship, then the non-controlling interest should also be valued, and that should be accounted for. That is our next step, third step. In the fourth step, we need to recognize and measure goodwill or gain from a bargain purchase. Why does it happen? Now, suppose we are dealing with a holding subsidiary relationship, and in that case, 70% of the shares of the company, of the subsidiary company, has been acquired at rupees, say, 3,50,000. So there is 30% shareholders left. They must have a value, obviously. If the company is a listed company, then we can directly calculate their fair value. If not, there are other methods to calculate the same. One of the method is known, method is the proportionate fair value of the identifiable net asset method. So whatever be the method, the non-controlling interest holders, the shares of the non-controlling interest holder, they have a value. Now, if we add this together, that is 70% value of the shares that we paid at a purchase consideration and 30% of the value of share which the non-controlling interest holders have, we get the value of the entire company's shares. Against the same, we need to compare the net assets of the company, identify net assets of the company, the fair value. Now, it may so happen that the fair value of identifiable net asset is 1 lakh, while the value of the company, that is purchase consideration plus NCI, is more than 1 lakh. So in that case, the company is having some amount of goodwill, intangible and assets, which we can recognize as a goodwill. On the other hand, if it happens that the net asset value of the company, identifiable net asset value, fair value of the company is higher than the purchase consideration plus NCI, then the difference is known as gain from bargain purchase, which is reported as a capital gain under capital reserve in the balance sheet. So since we need to recognize this goodwill and bargain purchase, we need to compare the identifiable net assets fair value against purchase consideration plus NCI and get the difference measured and then recorded. Now, once done, the final step may be just to disclose all the relevant information relating to this business combination, be it holding subsidiary arrangement or an acquisition or amalgamation kind of an arrangement. To give it a better idea, goodwill measurement we can explain in form of a two-step process where excess of 1/2 is known as goodwill. This has been defined as per Ind AS 103. Ind AS 103 says that in order to measure and recognize goodwill, you just get the aggregate of fair value of consideration transferred. Say 70% I have acquired at 3,50,000. So 3,50,000 is the fair value of consideration transfer. 30% other shareholders, we need to get their value. So the amount of any non-controlling interest we need to recognize, their value should also be considered here. And if the business combination is being achieved in stages, the acquisition date fair value of the acquirer's previously held equity interest in the acquiree we need to consider. Suppose initially there was 30% investment by H in S. Subsequently, H acquired another 40%. Together it gives H 70% voting right in S. So on this second date, H becomes the holding company, and that is the date of acquisition on which the goodwill has to be calculated. For that purpose, you can see on the second day only 40% has been acquired, and purchase consideration reflects only 40% of the acquisition of shares. But basically, there was a previous acquisition already done in day one, and it may so happen that the rate was different. So the previous investment is to be converted, is to be measured at a fair value on the date of acquisition, so that current 40% and 30% previous, they are measured at the same value. The resulting gain will be reported in the profit and loss statement. This we will discuss in detail because we have a slide on step acquisition or acquisition business combination in stages. We will consider one numerical problem also on that. So these three added together, if higher than the assets and liabilities recognized in accordance with Ind AS 103, that is fair value of identifiable net assets, the result is goodwill. Otherwise, there is a gain from bargain purchase. If goodwill is negative, that negative goodwill is recognized as gain from bargain purchase directly in equity under the name capital reserve. In company's balance sheet under the section equity, it will be reported under the head capital reserve. Now, how to recognize this particular changes? The recognition is simply done by performing one accounting or two accounting entries in the books of the acquirer. The entry will be assets account at fair value debit, assets account of the acquiree. If there is a goodwill calculated, then goodwill is debited. Liabilities at fair value is credited. Whatever purchase consideration you are paying to consideration is credited. If you are acquiring in a holding subsidiary arrangement less than 100% of the subsidiary company, then one NCI at a appropriate value will be recognized. And if there is a negative goodwill, it is treated as gain on bargain purchase. Finally, this consideration is paid. The payment can be in form of cash, in form of issue of equity share at par or at premium, or by issuing preference shares or debentures. Even contingent consideration is also possible. So these are the two accounting entries in the books of the acquirer. Because of this accounting entry, in the acquirer books, whatever assets and liabilities the acquirer is having at its carrying amount needs to be added to the fair value of assets and liabilities acquired from the acquiree company. In case of holding subsidiary relationship, this consolidation is done in a separate set of books and a consolidated balance sheet is prepared. While in case of acquisition or amalgamation, this is done in the standalone books where the carrying amount of the assets already owned by the acquirer will be merged with the fair value of the acquiree's assets and liabilities. And in case of acquisition and amalgamation, there will be no NCI reported. Next. Now, if you want to know what will be the accounting entry in the books of the company which is going into liquidation in case of acquisition and finally the amalgamation, then these are the accounting entries. Everything is done through realization account. So the acquiree, the company going into liquidation, it will transfer its assets to realization. All the book value or carrying amount of the assets will be transferred to realization. Similarly, all the liabilities, external liabilities, that is current liabilities and long-term loan and non-current liabilities, will be transferred to the realization account at their book values. For consideration, there will be a due entry, acquirer company account debit to realization with the aggregate amount of purchase consideration. If there is any internal, obviously there will be internal liabilities like equity share capital and other equities. Those will be transferred to equity shareholder account. Next, for realization of assets not taken over, if those are sold, then bank account debit to realization. if those are taken over by anyone else, that will be done accordingly. For settlement of liability, it will be realization to bank, which are not taken over. For transfer of realization profit, this realization account will be debited to equity shareholder. That is, realization profit is transferred to equity shareholder. Similarly, if there is a loss, that is also transferred to equity shareholder. And finally, the settlement is done by discharging the purchase consideration. So the receipt of the purchase consideration is to be recorded. For that purpose, equity shareholder account will be debited to shares in the acquiring company, that may be equity share, preference shares, and debentures in the acquirer company. And also, if there is any cash payment, cash account will also be credited. So these are actually the accounting entries in the books of the acquirer, and in the books of, it will be acquiree. Sorry, I need to just make this correction. Just a minute. It will be acquiree under acquisition. This is accounting entry in the books of the acquiree. Okay. So now let us consider a few small numerical problem as well as certain comprehensive problem on this business combination. Let me correct it. It will be available. The corrected version will be available in the website. Okay. So let us consider certain small numerical problems on business combination. How on the date of acquisition, the assets and liabilities are recognized and goodwill or gain from bargain purchase is identified. Okay. Just a minute. Let me zoom it a bit. Okay. This is the first illustration that we are going to consider. Here, the acquirer, it is a holding subsidiary arrangement. Acquirer, that is the holding company, obtains 100% shares of the acquiree, that is, it is 100% subsidiary. H Limited acquires 100% of S Limited on for rupees 9,60,000 and paid the consideration in cash. Fair value of S Limited's identifiable net asset was 9 lakh. We need to calculate the NCI, goodwill, or gain from bargain purchase, and show the treatment in the books of H Limited. So simply, since H Limited has acquired 100% of the shares of S Limited, there is no question of any NCI. It is a 100% subsidiary case, no NCI is there. Now, fair value of net assets identified is 9 lakh, purchase consideration 9 lakh 60, and NCI is nil. So in that case, if you compare, purchase consideration plus NCI is still higher than the fair value of net assets, identifiable net assets. So this is the case of goodwill. Accordingly, the goodwill will be 9,60,000 the purchase consideration plus nil the NCI minus fair value of identifiable net assets 9 lakh. So it will be 60,000. Now comes the question of recording in the consolidated. It is to be notified. Please, it is to be please noted that H Limited, the whole acquirer, is performing this accounting entries in consolidated accounts. Okay, the consolidation here is being taken in a separate set of books. Now the net assets is being debited. Goodwill account is debited to consideration 9,60,000 and it is paid to cash. So consideration account debit to bank 9,60,000. In the standalone accounts of H Limited, this entry will be simple. Investment in S Limited account debit to bank. Now let us pick up another situation where there is NCI, that is, acquirer is obtaining less than 100% of the shares of the acquiree or subsidiary in this case, and NCI is measured at a value which at a method called proportionate fair value of identifiable net assets. In this context, let me remind you that NCI is measured in two ways. First of all, proportionate fair value of identifiable net assets method, under which the subsidiary or the acquiree's net assets, we need to first calculate the fair value of net assets of the acquiree, and then the percentage share held by NCI is multiplied against the same to get the value of NCI. Okay, this is we call proportionate fair value of identifiable net assets. There is another method which is called fair value method, where we calculate the fair value of the NCI itself, there are two methodology again. Either if the market value of NCI is available, consider that to be the fair value, or if it is not available, then the purchase consideration should be taken as the base, and proportionately, which is called par value basis valuation, the NCI amount will be calculated. We will come to that. Now, in this case, the NCI is measured at proportionate fair value of identifiable net assets method. Now, H Limited acquires 70% of S Limited for 8,50,000 and issued equity shares at par. Fair value of S Limited's identifiable net assets is 9 lakh. Calculate NCI and goodwill and show the treatment. Assume that H Limited measures NCI at proportionate fair value of identifiable net assets. So, in the given case, the fair value of net asset is 9 lakh. Purchase consideration 8,50,000 for 70% shares, and NCI, that is the 30% share, will be value under proportionate fair value of net assets. That is 30% of 9 lakh we need to consider, which is 2,70,000. So purchase consideration plus NCI, it is higher than fair value of net asset. It is the case of goodwill. Goodwill is valued at PC plus NCI minus fair value of net assets. That is 8,50,000 plus 2,70,000 minus fair value 9 lakh. So it comes to 2,20,000 in that way. Now the accounting entry, it will be the same. That is net asset as debited. It will be debited. Goodwill is debited to consideration. And since this time we are getting some NCI, they are also credited 2,70,000, the value we have determined just now. Finally, the discharge of the consideration account debit to equity share capital 8,50,000. Since the shares were issued at par, there is no question of any securities premium. In the standalone account, it will be simply investment in S Limited account debit 8,50,000 to equity share capital, nothing else. Now, let us consider one question where NCI is measured at fair value basis, at fair value and at par value basis. Say X Limited acquires 70% of Y for 8,40,000 and issued equity shares at 12 per share, including ₹2 at premium. Fair value of Y Limited's identifiable net assets amounted to 9,60,000. Calculate NCI and goodwill and show the treatment in the books of X Limited, assuming that X Limited measures NCI at fair value. Okay. Now see, here NCI is to be measured at fair value, but for NCI, specific market value is not given. So what we will do, we will consider this price paid as purchase consideration to be the base value. That is 70% share is having a value of 8,40,000. So corresponding 30% share, how much the value it will fetch. In that way, we will determine. So in the given case, fair value of net asset 9,60,000 again, purchase consideration 8,40,000 for 70% share. So NCI at fair value we are measuring, taking the PC as the base, considering PC as the base, and this is called par value basis valuation. So it will be 8,40,000 divided by 70% into 30%, so 3,60,000. And accordingly, the goodwill value will be purchase consideration plus NCI minus fair value of net assets, that is 8,40,000 plus 3,60,000 minus 9,60,000, so 2,40,000. In the given case, the shares have been issued at ₹12 per share, including ₹2 premium. So there will be a securities premium portion as well. Now 8,40,000, the purchase consideration is to be discharged by issuing shares at ₹12. So number of shares to be issued is 70,000, and accordingly we will determine what is the amount of equity share and what is the amount of securities premium. Now net assets debited 9,60,000, goodwill calculated 2,40,000, consideration 8,40,000, and NCI we have just calculated under fair value method 3,60,000. So the discharge of consideration is consideration debited 8,40,000 to equity share capital 70,000 shares into 10, while the securities premium will be 70,000 shares into the rest of the ₹2. That is 1,40,000. In that way, the discharge of consideration is done. In the standalone account, it will be investment debited to equity share capital to securities premium. Okay, in that way. Now, not necessarily in all the cases there will be a goodwill. There is a possibility that the PC plus NCI is lower than identifiable net assets fair value. So in that case, there will be a good gain from bargain purchase, which will be reported in the other equity segment under other equity segment, the particular account will be capital reserve under which it will be reported. Now the non-controlling interest is measured at proportionate fair value of net assets, gain on bargain purchase. That's the case we need to consider now. P Limited acquires 80% of Q at 8,20,000 payable in cash. Fair value of Q Limited's identifiable assets amounted to 15 lakhs and that of identifiable liabilities 3 lakhs. Calculate NCI goodwill or gain from bargain purchase and show the treatment in the books of P Limited. Assuming P Limited measures NCI at proportionate fair value of identifiable net assets. So now the fair value of identifiable net assets in the given case is 15 lakh minus 3 lakh. Why? Because the assets are having a fair value of 15 lakh while liabilities are having a fair value of 3 lakh. So basically the net asset is 12 lakh. Purchase consideration 8 lakh 20 for 80% share and the rest of the 20% is to be measured at proportionate fair value method. So it is 20% of 12 lakh, that is 2,40,000. So gain on bargain purchase is the case because the purchase consideration plus NCI is lower than fair value of net assets. Here fair value of net assets is 12 lakh while PC plus NCI is 8 lakh 20 plus 2,40,000. So it is 1,40,000 that value. So since this is a case of gain on bargain purchase, you can see assets are debited while liabilities are credited. Consideration is also credited as well as NCI. But at the same time, we recognize one gain on bargain purchase 1,40,000. Consideration is paid in form of cash. So the payment has been done through bank. And in that standalone account, it is only investment to bank 8,20,000. Okay. Now, so far we have discussed the business combination cases and the accounting entry to be performed on the date of acquisition, considering the scenario of holding subsidiary arrangements. In illustration 1, we have considered 100% subsidiary, while in the rest of the 3 cases, we consider 70% or 80% acquisition by the holding company and 30 or 20% being the non-controlling interest holder. Obviously, when we will be dealing with holding subsidiary arrangements, the business combination transactions that we have already discussed will show this type of situation of NCI. Their valuation will have an impact on goodwill as well. However, if there is an acquisition in a proper sense or amalgamation, 100% of the shares of the acquiree company is acquired by the acquirer company, and in that case, there is no possibility of acquiree company to coexist. They will go into liquidation. So there is no question of any further date of consolidation. The consolidation will be done on the date of acquisition only, and that is into the standalone books of the acquirer. The acquiree's assets and liability at their fair value are to be merged with the acquirer's current carrying value of the assets and liabilities. So there will be no question of any NCI, but goodwill or gain from bargain purchase is always possible, as PC and fair value of net assets may not be the same, especially when the purchase consideration is determined on some other basis other than the net assets. So we will consider one such case here. Just a minute. Okay. This is an illustration on takeover. A Limited takes over B Limited for 12,60,000. Fair value of B Limited's net assets at the time of acquisition amounts to 11,80,000. Required, calculate goodwill and show journal entries in the books of A Limited. Now you can see that here, first of all, A Limited is acquiring B Limited, taking over the B Limited. So 100% of the shares of the B Limited is being acquired by A Limited, and accordingly, there is no possibility of any NCI. However, goodwill is possible because you can see the purchase consideration which is being paid is 12,60,000, while the fair value of the B Limited's net assets is 11,80,000. So 11,80,000 of the net assets is being acquired by paying a amount of 12 lakh 60, a premium amount has been paid. That additional amount is paid because of the goodwill, reflecting all the intangible assets of the unrecorded intangible assets of the actuary company. So here goes the explanation. It is a case of business combination to be accounted under Ind AS 103. Why? Because A Limited is taking over B Limited, so A Limited is getting control of the B Limited. That is the reason. Here B Limited is the actuary and A Limited is the acquirer. Why? Because A Limited is taking over and paying the amount to B Limited. So A Limited is the acquirer and B is the actuary. Now actuary ceases to exist after the takeover. Since this is an takeover transaction, in case of takeover, B Limited will go into liquidation and all the net assets of the B Limited will get merged to A Limited. In the individual set of books of A Limited, that is standalone set of books of A Limited, no separate consolidated books needs to be open. It is open only in case of holding subsidiary relationship. The acquirer, that is A Limited, net assets of B Limited, that is the actuary, will be recognized and measured at fair value, and consideration will be settled at fair value. Any excess will be treated as goodwill. Now here, PC is 12 lakh 60, NCI obviously and logically is nil. Fair value of net assets is 11 lakh 80. So goodwill is consideration minus net assets. That is 12 lakh 60 minus 11 lakh 80. That is 80,000. 80,000. So the journal entry in the individual, this is important. In the individual set of accounts is net asset account debit 11 lakh 80, goodwill account recognize 80,000, to consideration 12 lakh 60, and obviously the consideration will be finally paid, whatever be the mode that will be considered. Here the mode has not been mentioned. We have not done the corresponding entry. If it is in cash, then consideration account debit to bank will be the appropriate entry to be done. So the main difference that you can identify between the previous illustration and this one is that in the previous illustration, the subsidiary was coexisting and the journal entry was done in the consolidated set of accounts, not in the individual set of accounts. The merger takes place. But here, in case of a takeover, not a separate set of books, but in the original set of books, the assets liabilities of the acquiring company is being brought to the individual set of accounts. Okay, so that is the major difference. Now, these are certain small illustration which will be important for your MCQ purpose. However, for comprehensive problem, we need to consider similar type of illustration also, and I will take up a few such illustrations now. Okay, so let us go to this one and right. Okay, so page number 177, we will need to consider 74. Yeah. Illustration number 10, let us start with. X Limited agreed to take over Y Limited as on 1st October 2018. A bit old problem, and accordingly, there you will identify one treatment of corporate dividend tax which doesn't exist now. No balance sheet of Y Limited was prepared on that date. Summarized balance sheet of X and Y as on 31st March 2018 were as follows. Now, the summarized balance sheet shows that in the asset side, fixed assets, which we call non-current assets. There are certain current asset stock, which we call inventory, then receivable, then there are bank miscellaneous expenditure. Now we don't have miscellaneous expenditure. We don't report miscellaneous expenditure on the asset side, but we consider this to be a deduction from the reserves or PL. That is from reserve surplus. In the liability side, we have equity shares, we have reserves and profit and loss, and creditors. Okay, so this is a summarized balance sheet, so there is no need to follow the format of division 2 schedule 3. Additional information available for the 6 months period from 1st April 2018 X Limited and Y Limited made a profit of 5,40,000 and 3,60,000 respectively. Now, after writing of depreciation 10% per annum on their fixed assets. So the takeover takes place on 1st October and we are having balance sheet on 1st April. So from 1st April to 1st October, these 6 months, these profits have been arrived at after writing of depreciation at their 10% on the fixed assets. Both the companies paid on 1st August 2018 equity dividend of 10%. So there is a further reduction in the PL balance as well as the cash balance, which we need to consider. Dividend tax 15% was paid by each of the company on that payment. Goodwill of Y Limited was valued at 1,68,900 on the date of takeover. Now, whenever there is a takeover, the company will value its assets and liabilities, and accordingly, it may at the same time identify some amount of goodwill also, which it will sell to the acquirer, and accordingly, acquirer will pay the value for goodwill. This goodwill will then become purchase goodwill to be recorded by the acquirer. The goodwill of Y Limited was valued at 1,68,900 on the date of takeover. Stock of Y, subject to the abnormal item of 8,500 to be fully written off. So there is a fair value calculation to be done here, would be appreciated by 20% for the purpose of takeover. And X Limited would issue to Y Limited shareholders fully paid equity share of 10 each on the basis of comparative intrinsic value of the shares on the date of takeover. See, this intrinsic value is calculated on the basis of net assets. Okay. So accordingly, this statement is simply showing that the purchase consideration is calculated based on net assets. And whenever purchase consideration is calculated based on net assets, no separate goodwill at the time of acquisition will arise. Okay, because this goodwill has already been valued separately and included in purchase consideration. So no separate difference will arise. Now, computation of cash and bank balance is required here because there are certain transactions like earning profit, paying dividend, etc. So the 1st April 2018 cash and bank balance is not dependable. It's not actually the amount to be considered for merger purpose. Now, cash and bank balance of the companies as on 1st October, we can determine in this way. The balance on 1st April, with this we have added net profits. We are to add depreciation for 6 months, 77,563,000 to get the total of the above. Because while calculating net profit, we deduct depreciation, though depreciation is not a cash payment or cash expenditure. That is why when we are adding net profit, we are adding net profit after depreciation. So depreciation needs to be added to get the cash value. From this, payment has been done in form of dividend and dividend distribution tax that we have deducted. So we got the balance on 30th September, 727 lakh and 5,500, sorry, and 43500. Then the net assets. Simply for X and Y, all the assets are to be considered along with the newly calculated goodwill that has been already shown in the additional information. So for Y Limited, that goodwill we have considered fixed assets since the 1st April 2018 balance sheet is subject to depreciation at the 10% for 6 months. We have deducted the depreciation on fixed assets and accordingly recalculated the value on 1st October or 30th September. Data remains the same. Stock, there was appreciation of 20% that has been shown. Cash and bank balances as computed above. That gives us the total assets, from which the outside liabilities, only the creditors we have deducted to get the value of net assets as on 1st October, which we have divided with the number of equity share to get the intrinsic value per share 15 and 16. So now the consideration will be 24 lakh. The net assets of the Y Limited, that is actually the consideration to be paid by issuing shares of X Limited having an intrinsic value of 15 rupees. So 1,60,000 shares will be issued. Based on that, now we need to form the balance sheet. Okay. Now here balance sheet was not required. So here the balance sheet has not been shown. if we prepare a balance sheet, X Limited's own book values are to be added with the fair value of Y Limited's assets and liabilities. The goodwill will also appear. Y Limited's goodwill is now the purchase goodwill of X Limited. There is no question of any NCI. Okay. And the share capital of X Limited will be enhanced by the new shares of 1,60,000 issued. Okay. And if we assume that shares were obviously here the shares have been issued at rupees 15, so 5 rupee is to be considered as the securities premium, while 10 will be the par value, and accordingly the amount will be segregated between share capital and reserve surplus or other equity in form of securities premium. Let us consider another problem which requires preparation of balance sheet also. Okay, let us go to page number 186. Yes. Now, in this problem number 14, the following are the balance sheet of Good Limited and Bad Limited as on 31st March 2018. In crores, it has been given. Equity and it is an old problem I have already mentioned. So the format is as per Schedule 3, Division 1. Obviously, in the examination, you will get Division 2 of Schedule 3. So equity and liabilities, equity share capital, there was authorized capital, then there is issued and subscribed capital 12 and 5 crore, other equity 88 and 10. So total equity is 115, from which unsecured loan from Good Limited, there is a in the books of Bad Limited, there is an intercompany loan 10. Accordingly, total value is 125. PPE at cost less depreciation, so written down value of PPE, investment and cost 30 lakh equity share of 10 each of Bad Limited. That is already Good Limited is holding 30 lakh shares of Bad Limited, and now the rest of the shares is being acquired. Long-term loan to Bad Limited is 10, current assets less current liability 200 minus 30, 133.67, and that is 19 in the case of Bad Limited. So that gives us 125, the summarized balance sheet actually. On that debt, Good Limited absorbed Bad Limited. The members of Bad Limited are to get 1 equity share of Good Limited issued at a premium of 2 per share for every 5 equity share held by them in Bad Limited. The necessary approvals have been obtained. You are required to post the journal entry in the books of 2 companies. Now, this is basically here we are highlighting the accounting in the books of Bad Limited, Good Limited, because the adjustments are quite simple. Purchase consideration has been done 1:1 basis. Shares have been issued at a premium of 2, and finally difference between the purchase consideration and the fair value, though fair values have not been given separately, the book value of net asset we will consider as the fair value, and the difference, if any, will be reported as goodwill. Now, Battle Limited, that is the acquiring company, how it will perform the accounting in its books? Through realization account. So all the assets will be transferred to realization, their carrying amount. Realization account debit to PPE and current assets. Similarly, all the liabilities will be transferred to realization. That is provision for depreciation, then current liabilities and unsecured loan, all are transferred to realization. Then purchase consideration will be due. So Good Limited account or acquirer account debit to realization. 1.20 crore will be the case, because you can see that at a premium of rupees 2, the purchase consideration is to be discharged. Now, the purchase consideration will be equivalent to right, this 10 plus just a minute. The purchase consideration is 1.20 crore. So Good Limited account debit to realization will be 1.20 crore. Equity shareholders will get the loss on realization will be transferred to equity shareholders 13.80. Then the equity share capital will be debited. So it is 5 plus 10, 15. The internal liabilities are transferred to equity shareholders, and equity shareholders are being discharged the purchase consideration, already they were holding 30,000 shares. So equity shareholder of Good Limited account, equity shareholders account debit to Good Limited account 0.72, being 3/5 of the consideration due from Good Limited adjusted against the amount due to Good Limited, because already 30,000 shares were held by Good Limited itself. Okay, so whatever number of shares will be issued to Bad Limited, a portion will come to Good Limited itself. 30 lakhs out of 50 lakhs, Good Limited is holding. So 3/5 is actually the equity share up to, to be adjusted. That from the consideration will be adjusted, and rest of the consideration is actually paid to the equity shareholders. Now, equity shares of Good Limited 0.48 will be just cancelled out, being the receipt of 4 equity shares at rupees 12, 4 lakh equity shares of rupees 10 each at 12 per share for allotment to outside shareholders. So this is the 3/5 shareholder, this is the rest of the 2/5 shareholder, and finally equity shareholders debit to equity shares. Those outside shareholders will get the share. Now, in the books of Good Limited, now you can see the investment measured at fair value and the difference with book value transferred to PL account. Now, 0.72 is the value of the already held shares of Bad Limited, which are there with Good Limited already. Now, these shares are being valued at rupees 3 lakh, or at rupees 3 crore, sorry, at rupees 3 crore. So the difference between the two, that is 0.72, is actually the fair value, and 3 crore is actually the book value which was there. You can see 3 crore is actually the book value. So the difference is being considered as a loss, and that is debited to profit and loss account. So now the investments are updated at the fair value. Now the PPE account, whatever assets and liabilities we are getting from the Bad Limited, those are debited and credited. So PPE account debited 6, current assets account debited 134. You can see PPE 34. Just a minute. And current assets, yes, current assets 134 we are getting. So PPE 6, current assets 134. PPE was this one. PPE 6, current assets 134, current liability 115. 115 is the current liability. Unsecured loan 10. Then consideration 0.48 payable to the outsiders are credited. Investment in BAT Limited at fair value is also credited, because that is being cancelled out now. And the difference being on the negative side, it is gain on bargain purchase credited 13.80. Now the consideration account debit to equity share capital to securities premium for the consideration of 0.48 being discharged at a premium of rupees 2. Unsecured loan is an intercompany transaction are cancelled out. Okay, so in that way we have we can prepare the balance sheet of the holding company. Okay, so in that way, we can prepare the combined balance sheet after the acquisition. Now, let us consider another problem, illustration number 15. A similar thing, but this time the acquiree is having an investment in the acquired ring company. Okay. Following at the extract uh, balance sheets of two companies, B Limited and D Limited, as on 31st March 2018. Sundry assets 7 lakh 50, 3 lakh 50, 10,000 shares in B Limited 1 lakh, already held by D Limited. In the previous case, we considered acquiring company, acquirer having investment in acquiring. Here, the opposite. Achha. Now, B Limited was to absorb D Limited. On the basis of intrinsic value of shares, the purchase consideration was to be discharged in form of fully paid shares. A sum of 20,000 is owned by B Limited to D Limited. Also included in the stocks of B Limited, 30,000 goods supplied by D, cost plus 20%. Give journal entries on both the company. Now, in the books of D Limited, all assets will be transferred to realization to sundry assets. All liabilities are transferred to realization, creditors to realization. Then purchase consideration due, B Limited debit to realization. The amount has been calculated in working note number 2. Let us move to working note number 2. Now, first of all, the fair value of assets we can calculate first. Sundry assets of both the companies we have mentioned. Investment in B Limited, we will value at the intrinsic value for B Limited. So first B Limited column needs to be completed. Now from the sundry assets, you deduct the creditors, that will give a net assets of the B Limited divided by number of shares outstanding for B Limited. It is 12 rupees intrinsic and fair value of share of B Limited. At this fair value, B Limited will measure the investment 10,000 into 12, 1,20,000. So that gives us the net assets 3,75,000 finally divided by 30,000, it is 12.50. Okay, so consideration, if you now want to calculate, then A Limited already is having a number of shares of D Limited is 30,000 and value is 3,75,000. Number of shares which are to be issued at intrinsic value of B Limited 12 is 31,250, out of which already B Limited is holding 10,000. So further new share to be issued is only 21,250 and corresponding total consideration is 2,55,000. In that way, the 2,55 came. Now, shares in B Limited account debit to B Limited. In that way, purchase consideration is discharged. Equity share capital and reserves are transferred to shareholders, and shareholders are finally getting the shares in B Limited. 3,55,000 already. The share which was being held by the D was 1 lakh. So in that way, 2,55,000 plus 1 lakh is actually 3,55,000. The realization profit has been transferred basically. Okay, so in the books of B Limited now, if you want to calculate the, if you want to pass the accounting entries, it is assets account debit 3,50,000 less the unrealized profit. The adjustment is there, or you can adjust it later on also. In that case, the consideration amount will be a bit different. So assets account debit 3,45,000 and goodwill will be 5,000. And two creditors 95,000 and to consideration 2,55,000. This is discharged by issuing equity share capital 21,250 shares into 10 plus securities premium 21,250 into 2, 42,500. Finally, cancellation of intercompany owings 20,000 will be cancelled out, which was the intercompany profit. Okay, so if you now prepare the combined balance sheet, then in that combined balance sheet, the sundry assets are actually added together of both the companies. Sundry assets are added together, and there is intercompany adjustment 20,000 and unrealized profit on stock 5,000. So in that way, 10,75,000. Goodwill already calculated 5,000, and equity share capital, it is 7,12,250, 7,12,500, along with the 21,250 shares newly issued. Other equity, it is 1 lakh already the reserve amount, and now securities premium is being 42,500. So total 142,500 is there. Trade creditors of both the companies merged into one, 2,25,000. That gives us a balance sheet of 10,80,000 in both sides. Okay, so these two were comprehensive problem on acquisition of one company by another company. Now we will take up certain special issues with respect to this business combination. So in business combination, whenever any kind of business combination takes place, it is normally accounted under acquisition method, which involves those steps we have already considered, and we have considered the small illustration as well as comprehensive illustration based on this only. Now there are certain exceptional cases, or there are certain additional issues that need to be discussed in the context of business combination. The first one that we need to discuss here is business combination achieved in stages. Okay. Now, if you just consider that second comprehensive problem where Good Limited was having investment in Bad Limited to the extent of 30 lakhs already. Now, in the similar way, if there happens a situation where one company, say H Limited, has initially invested not to the extent of controlling, but to the extent of only 30% of the voting right of the subsidiary of the company S Limited. On that date, there is no control, and accordingly, no business combination is there. But subsequently, if another 40% of the shares of S Limited is acquired, then cumulative shareholding reaches to 70%. And on the second date, there is a business combination as control is being acquired by the H Limited in S Limited. Now, wherever this is the case, the question that comes to our mind that on the date of acquisition, we need to compare the PC plus NCI if applicable against the net assets fair value to get the amount of goodwill. Now the second date, on the second day, the additional 40%, the rate at which it is acquired, and the rate at which the previous, say 30-35%, whatever was the previous acquisition, previous investment, the rate may not be the same. The new acquisition at the time of controlling, getting the control may be at a higher value as compared to the previous one. In that case, if we want to consider the purchase consideration, it is basically having two separate installments. One which is being paid at now at a higher rate, while the other being paid at the which was paid earlier, say at a lower rate. These two are not additive. In order to add the same, what we need to do, the previous installment, the previous investment needs to be brought to the fair value also today, that is date of acquisition. This conversion obviously may lead to certain fair value gain. So that particular fair value gain should be credited to either profit and loss or other comprehensive income, as the case may be. As the case may be means the previous gains while having that investment, whatever was the previous gain in earlier years, if it was transferred to comprehensive income, the current gain also has to be transferred to comprehensive income, or otherwise it will be to PL. Then even if the previous gain have been transferred to other comprehensive income, which is reclassifiable, then also the current gain you can transfer to PL along with the previous gain now to be reclassified in PL. That gives you the value of say total 70% shareholding now, against which 30% NCI should be valued, and from the total value, aggregate value, you deduct the value of the fair value of identifiable net assets. In that way, the goodwill needs to be calculated. This is called business combination in stages. Okay, let us quickly have one problem on this business combination in stages. Just a minute. Yeah. Consider this illustration number 9. Entity A acquired 35% of entity B in 2015 for rupees 35,000. In 2016, fair value of the shares of entity B is rupees 42,000. Thus, 7,000 reported under OCI, assuming reclassifiable. In 2016, A further acquired 40% stake in B. Consideration paid 60,000. Entity A identifies the net assets of B as 1,20,000, value 35% shares at 45,000. NCI is valued at proportionate net asset basis. Show working and journal entries. Now, A will make transfer to B PL account. How much? Let us find out. First of all, initial acquisition amount of 35% share was 35,000, which was revalued at 42,000 in 2016, and 7,000 revaluation gain was transferred to OCI. So that was the one transferred to OCI, assuming reclassifiable. And now this 42,000 is being valued at 45,000. You can see here value of 35% shares is at 45,000. So there is another gain of 3,000. Now all this gain are to be transferred to PL. 10,000. So now the fair value of 35% share is 45,000 plus 40% new share acquired at 60. So together it is 60 plus 45 plus the question of NCI is there, because 75% we have acquired, A have acquired. So there is 25%, and that is to be valued at proportionate net asset basis. So fair value of consideration now paid 60. Fair value of previously held interest is 45, and non-controlling interest 1,20,000 is the identifiable net assets into 25%, that is 30,000. Altogether, it is 1,35,000, against which we are comparing fair value of net assets of the acquiree 1,20,000. So the goodwill is 15,000. Now the entry. The entry simply will be, first of all, we need to revalue the investment first. Now the investment previously was 35, which was revalued at 42. So that much entry has been done. Now another 3,000 is being added to the investment. So investment account debit 3,000, 42 to 45. OCI is now being cancelled out and being transferred to PL. So PL, it is previous gain 7,000, previous fair value gain 7,000, and current fair value gain 3,000, so 10,000. Now the net assets 1,20,000 is debited. Goodwill recognized 15,000 to consideration 60 to investment 45 to NCI 30,000. That is, the investment is being cancelled. Against the investment as well as consideration, you are getting the net. Okay. Now remember, if you consider that illustration number, second illustration in case of comprehensive problem, 3/5 of the share was already had with Good Limited. So Good Limited was already holding 60% of the equity shares of Bad Limited. This is not a case of business combination in stages, because already the control was with the acquirer. Control was with the Good Limited. This is basically known as transaction with equity participants. That is further share acquired. Okay. So that 3/5 was the previous acquisition 60%, and now the rest of the 40% is being acquired to get the 100% of the company, and the company merges with the acquirer. Business combination achieved in stages. This problem we have covered. So now let us consider, just a minute. Let us consider another some problem on this business combination. Let me see the business combination. Yes, data calculation. Yes. This is another problem. H Limited and S Limited holding subsidiary situation, not acquisition rather. On 31st March 2020, the balance sheet of H and S were as follows. PPE and investment 80% of S Limited already. Just a minute. So this is a case of the step acquisition rather than business combination achieved in stages. Okay. So this is the one which we have considered in our comprehensive problem number 2 as well. So you can see the 31st March 2020, the balance sheet of H Limited, S Limited are given below. PP are there, investment in 80% share of S Limited 9925. In inventory, trade receivable, cash and cash equivalent, and in case of liability, we have share capital, other equity, in return earnings, and trade payables. H Limited acquired, this is important, 15% share in S Limited on 1/4/2019 at 1800 lakhs and further 65 shares on 30th September 2019. So you can see in 2019 itself, on the first day, very first day, 15% was acquired. That is not the acquisition of control, but on the second day, 30th September 2019, there is further 65% acquired. So on the second day, we got control. H Limited got control. Okay. First was 1800, following 8125. Profits have been earned evenly during the year. 1/4/2019, the balance of retained earnings in other equity was 6,000 lakhs. It is on the opening day. The fair value asset liability were not defined from the book value, and NCI was valued at proportionate fair value of identifiable net assets. Now, in the given situation, the first acquisition 15% is not the control, not giving us the control because it is less than 50%. Then when further we have acquired 60% share, together the cumulative share reaches to 80%. And this particular day gives us the control. So accordingly, 15% was our acquisition on 1/4 and another 65% was our acquisition on 30th September. So together now we have 80% and NCI 20%. Analysis of other equity. Other equity or retained earnings are 1/4/29 was 6,000. Increase during the year. Closing balance minus opening balance will be 3,000. You can see 9,000 is the closing balance. So 9 minus 6, it is 3,000. Up to the date of acquisition increase, if we determine, it is 30th September 29, that is 6 months. So 1,500 is actually the increase up to the date of acquisition. So other equity on the date of acquisition is 7,500 and post acquisition profit is 1,500. Now fair value of identifiable net assets, since book value and fair value were same, share capital plus other equity will give us the fair value of identifiable net assets, which is 6 plus 7.5, that is 13,500. Then gain on loss on adjusting the initial investment. Initial investment 15% was at 1,800 lakh. So if we bring this value at the current value, considering 8,125 being paid for 65%, then it will be 8,125 into 15% by 65%. So it is 1,875. From this 1,800, the cost of acquisition of 15%, if we deduct, then 75 is actually the gain, which will be credited to the retained earnings of H. Purchase consideration 1,875, the adjusted value, and on 30th September, further 8,125. So purchase consideration is basically combined purchase consideration is basically 10,000. Now the goodwill, purchase consideration plus NCI. NCI is valued at proportionate fair value of identifiable net assets. Less fair value identifiable net asset is 13,500. So gain on bargain purchase is 800. NCI on the reporting date, NCI fair value was 2,700 on the date of acquisition, and post acquisition profits 20% will go to NCI, so 300 added, so 3,000. Other equity, opening balance of the holding company was 35, plus post acquisition profit share is 1,200, with which we are adding gain on adjusting the initial investment 75. So it is 36,275, and those values, with those values, we have prepared the consolidated balance sheet. So this is a comprehensive problem on step acquisition, where the first acquisition was made on 1/4/2019, whereas the business combination in stages acquired stages was done on 30 September 2019. Okay. Next, another important issue I need to highlight upon is reverse acquisition. What is reverse acquisition? Now, at the very beginning, while discussing the acquisition method, and I have mentioned that we need to first identify the acquirer. And normally, acquirer is the person who is the investor, who is investing. Now, obviously, whenever one investor is investing in another entity, he is the legal acquirer. And for the purpose of accounting also, we may consider him the acquirer. But there are certain situations where, in substance, acquirer is not the person who is the legal acquirer. That is, A Limited is investing in B Limited, but basically or effectively, B Limited is becoming the accounting acquirer. Okay, how it is possible? Okay. Let me see whether I have given an example or not. No, I have given. I have not given numerical example. So let me take one hypothetical situation. Okay, suppose there are two companies, X Limited and Y Limited. X Limited is having share capital of 1 lakh. Y Limited is having share capital of say 50,000. Now, X Limited has decided to issue 2 shares for each 1 share of Y Limited. Now, Y Limited is having 5,000 shares, X Limited is having 10,000 shares. Okay. Now, for each 1 share, or say X Limited is having 8,000 shares and Y Limited is having 5,000 shares. Okay. X is having share capital 80,000, Y 50,000. Now, suppose for each 1 share of Y Limited, X has decided to issue 2 shares. So, accordingly, for 5,000 shares of Y Limited, X will issue 10,000 of its own share. Okay. So X was originally having 8,000 share, plus for acquiring Y Limited, it had issued further 10,000 shares to the shareholders of B Limited. So accordingly, the combined entity after merger is having total share of 18,000. Of this 18,000, 8,000 shares are being held by the original previous owners of A, and 10,000 shares out of 18 is being held by the shareholders of B Limited. So in this case, the existing owner of X Limited, they becomes the NCI, and the shareholders of B Limited, they become the majority shareholder. This is the case where, though X is paying the purchase consideration and acquiring Y Limited, so X is the legal acquirer. Basically or effectively, X, the shareholder of X is becoming minority, and shareholder of Y becoming majority. So Y is the accounting acquirer, while X is the legal acquirer. This is a situation which is called reverse acquisition. So basically, reverse acquisition occurs when the entity that issues securities is identified, that is the legal acquirer, is identified as the acquiree for accounting purpose. The entity whose equity share, equity interest are acquired, that is the legal acquiree, must be the acquirer for the purpose of accounting in this case. For example, reverse acquisition sometimes occur when a private operating entity wants to become a public entity but does not want to register it in its equity shares. To accomplish that, the private entity will arrange for a public entity to acquire its equity interest in exchange for the equity interest of the public entity. In this example, the public entity is the legal acquirer, but it issued its equity interest, and the private entity is the legal acquiree because its equity interests were acquired. However, application of guidance in paragraph B13 to 18 of Ind AS 103 results in identifying the public entity as the acquiree for the purpose of accounting and private entity as the acquirer for accounting purpose. The accounting acquiree must meet the definition of a business that we need to keep in mind for this transaction to be accounted for as reverse acquisition, and all the recognition and treatment measurement principle for Ind AS 103 and requirement to recognize goodwill will apply in this case. Let us now take an example on this reverse acquisition. Okay, just a minute. Reverse acquisition. We have a very beautiful example on reverse acquisition in our new study material. Just a minute, let me zoom it a bit further. Okay, this one we are going to consider now. Suppose entity A acquires 80% shares of entity B and satisfies the consideration by issue of 3 shares of entity A for every share of entity B. Market price of 10 rupees share of entity A is rupees 25. Now the summarized balance sheet. Now net assets of A is 30,000, for B 20,000, and that is reflected by equity, means share capital plus other equity, 30,000 and 20,000. Number of equity shares already had with A Limited is 1,000 and B Limited is having a share of 750. Now, is it a reverse acquisition? Now see, A Limited is acquiring 80% of B Limited. B Limited is having 750 shares. Now 750 into 80% is 600 shares of entity B are being acquired by A Limited, and for that purpose it is issuing 3 shares of its own. So altogether it is issuing 1800 shares to entity B. Now shareholders of entity A hold 1000 shares, and now shareholders of entity B, they are holding 1800 shares effectively. The group is controlled by, therefore, entity B. So though here the legal acquirer is A, effectively the grouped entity or the consolidated entity is being acquired by entity B. So this is the case of reverse acquisition. In such case, accounting will be done in the books of entity A as the legal acquirer, but it will be assumed that entity B is the accounting acquirer, and accordingly assets and liabilities of entity A would be identified and effective consideration will be calculated. In case of amalgamation also, reverse acquisition may take place when it is indicated that after entity A and B amalgamated into, say, entity C, shareholders of entity B would control entity C. Although entity C is the legal acquirer, in the books, accounting recording will be done assuming that entity B is the accounting acquirer. Thus, de facto acquirer is the accounting acquirer and de jure acquirer is the legal acquirer. Let us take another example, a comprehensive one, illustration 16 on reverse acquisition. This one. Reverse acquisition, following the condition, takes place as H Limited acquires 100% equity shares of H Limited on 31st March 21. From the following data, pass necessary journal entries and prepare consolidated and separate balance sheet in the books of H Limited. Now see, here non-current assets 2000 and 3000, current assets 1000 and 1000, total is 3000 and 4000. Equity shares, capital X 100 shares and S 80 shares, other equity 500 and 1600, non-current liability 7 and 1200, current liabilities 800 and 400, total 3000 and 4000. H and S shares are quoted at 20 and 50 respectively on 31st March 21. H Limited issues share in exchange ratio based on quoted price only. Fair value of NC assets of H is 2,400 and 3,200. That is the fair value. Okay. Now, this is a business combination, no doubt. H Limited issues, since you can see 20 was the value of H Limited per share. S Limited per share value is 50. So H Limited will issue 2.5 shares for every 1 share of S Limited. Thus, 200 shares, that 80 into 2.5 of H Limited will be issued to the owners of S Limited, who becomes 2/3 owner of the group interest, because group comprises of 100 plus newly issued 200, that is 300 shares. So 100 shares belonging to the owners of H, while 200 shares belonging to the owners of S. For accounting purpose, therefore, the subsidiary is the subsidiary S Limited is considered as the accounting acquirer. As 100% share of S Limited are acquired, there is no controlling interest in the given case. Consideration transfer. Now, of the group, 100 shares are held by owners of H Limited and 200 shares are held by owners of S. So effective consideration from the viewpoint of accounting acquirer S Limited is the fair value of 100 shares held by H Limited. 20 into 100, that is 200, which is equivalent to 40 shares of S Limited at rupees 50. So in the consolidated set maintained by H Limited, recording will be made as if S is acquiring H Limited. Thus, net assets of H will be recognized at fair value and net assets of S will be recognized at carrying amount. Okay. So net assets of H identified 2,400 plus 1,000, the combined entity, minus 700 minus 800, the liabilities are deducted. So 1,900. Consideration transfer is 2,000 and 20 into 100, and goodwill is 100. So journal entry in the books of S Limited will be non-current assets of A Limited being acquired at fair value 2,400. Current assets remain at 1,000. Goodwill reported 100. To non-current liabilities 700. To current liabilities 800. To consideration 2,000, which is discharged by equity share capital 2,000. And the consolidated balance sheet will be in the books of H Limited, but acquisition has been done assuming S acquired H. So consolidated balance sheet on 31st March in the books of H Limited will be like this: consolidated non-current assets, the fair value of H plus book value of S. Okay, so fair value of H, you can see this is 2,400 and book value of S was 3,000, so 5,400. Okay, in that way. Goodwill reported 100. Then current assets 2,000, the combined entity, total 7,500, and equity share capital will be total 300 shares of H, carrying amount of S, issued by H Limited 2,000, and already carrying amount of S was, you can see this one, 800. So 800 plus 2,000 is 2,800. Other equity of S Limited 1,600. The non-current liability, book value of S plus fair value of H. Current liability, book value of S plus H, fair value of H. That gives you the total. Okay. The separate balance sheet of H remains as it is at its carrying amount, not at fair value. Okay. So this is a case of reverse acquisition. Now, we have some few minutes left, so we are going to our last topic under business combination, which is business combination under common control. Now, if a business combination, if in a business combination, all the combining entities or businesses are ultimately controlled by the same party or parties both before and after the business combination, and that control is not transited, it is a business combination under common control. Say A Limited, B Limited merging into a new company, which is being controlled by one of A and B, or it is a case of and business combination under common control. Common control business combination will include transactions such as transfer of subsidiaries or businesses between entities within a group. The extent of non-controlling interest in each of the combining entities before and after the business combination is not relevant in that case to determine whether the combination involves the entities under common control. This is because partially owned subsidiary is nevertheless under the control of the parent company. Now, business combination under business combinations involving entities or businesses under common control shall be accounted for using the pooling of interest method, not the acquisition method. I have already mentioned that there is an exception. Now, the pooling of interest method is considered to involve the following. The assets and liabilities of the combining entities are reflected at their carrying amount. So, not that actuaries' fair value will be considered, carrying amount of both will be considered. No adjustments are made to reflect fair values or recognize any new assets or liabilities. The equity share capital will be recorded at nominal value only. Consideration in excess of equity share capital will be recorded as goodwill or capital reserve in case of deficiency. The other equity of the transferor shall be carried by the transferee in the same form in which they appear in the financial statement of the transferor. Okay. So let us consider one problem on illustration of this business combination under common control from our new study material. Okay. It is illustration 19. Just a minute. Okay. Amalgamation or business combination under common control. Say there are two companies, DA Limited and TA Limited, DA Limited and TA Limited, which were amalgamated to form a new company, Data, on 31st March 2021, who issued requisite number of equity share of rupees 10 each to take over the business of DA and TA. The abstract of balance sheet of the companies have been given. Now you can see PPE values are there, financial assets, current assets, equity share capital, other equity, borrowing, current liabilities have been given. Past necessary journal entries in the books of DA and TA and Data and show balance sheet abstract after merger. Now the combining entities of the businesses are ultimately controlled by the same party or parties both before and after the business combination. It is a business combination under common control therefore. And pooling of interest method of accounting will be applied. Under pooling of interest method, we need to consider the carrying amount for the purpose of merger. So PPE 7,500 of DA merged with 8,000 for TA, so total 15,500. Financial assets merged together, current assets merged together, the carrying amounts are getting merged. Similarly, the equity share capital, other equity, borrowing and current liabilities, they will be merged together. Purchase consideration. Now, purchase consideration is yes, for equity share capital and other equity, if you add them together, that gives you the total net asset or equity 9,000 and 11,000. So basically 9:11 is actually the ratio for purchase consideration to be shared. Now, what is the purchase consideration? Total is since only equity share capital at nominal value will be recorded, so total recorded value will be 14,000, which is to be shared in 9:11 ratio. So 6,300 will be paid to DA and 7,700 will be paid to T. Total 14,000. So the recording will be in the books of DA, everything through realization. So liabilities are debited, assets are credited, and shares in Data to realization, the consideration is due. Then loss on realization is transferred to equity shareholders, and equity share and other equity balance are transferred to equity shareholder account, and finally equity shareholders account is discharged with the purchase consideration. Similarly, in case of TA Limited, assets in case of TA Limited, liabilities are debited, assets are credited, and realization is debited with the difference. Any kind of loss, okay, purchase consideration is received. Loss on realization has been transferred to equity shareholder account. Capital and other equity has been transferred to equity shareholder account. And equity shareholders are discharged with the shares of Data Limited. In the books of Data Limited, the entry will be combined PP, combined current assets and financial assets are debited. Combined liabilities are credited. Okay. Consideration is credited since there is no NCI. And other equity, the balancing figure representing either goodwill or gain from bargain purchase. Here it is gain from bargain purchase. Consideration is discharged by issuing equity share capital, and these are simply recorded. See, the recording is simply the two balance sheets carrying amount merged together. Okay. So this is the case of business combination under common control. We have another example, and this is going to be our last example for today. Just a minute. Let me. Okay. This is an example on demerger. Business combination under common control remains the case again. Z Limited has two divisions, X and Y, on 31st March 21. The division Y's extract of the balance sheet was given. Now, Q Limited new company is formed to take over division Y by issuing 1 crore equity share of 10 each at a premium of 15 per share to the shareholder of Z Limited or to Z Limited itself. Pass necessary journal entries in both the situation. Now, as the control of division Y was with shareholder of Z before the demerger, and after division Y is taken over by Q Limited, the control of Q Limited is still lying with the same shareholder of Z. Okay. This is a transaction identified as business combination under common control, where the transferee, that is Q Limited, and the transferor, that is Z Limited, Pooling of interest method is the method of accounting to be applied. Now, Z Limited shall close all its accounts for division Y, and Q Limited will record all the assets and liabilities at carrying amount, as in the books of the transferor. The equity share capital will be recorded at nominal value only. Consideration in excess of equity share capital will be recorded as goodwill or capital reserve in case of deficiency. And the other equity shall be cancelled in the books of the transferor and shall be carried in the books of the transferee in the same form in which they appear in the financial statement of the transferor. So when shares are issued to the shareholders of Z Limited, in that case, the borrowing, all the liabilities are cancelled. So liabilities are debited in the books of Z Limited, assets are credited, okay, and other equity is credited. Then assets and asset liabilities and other equity are closed and considered, that is the company has been liquidated, and consideration is not accounted being received by the shareholders directly. Okay, since the amount has been transferred to the shareholder directly, Z Limited has nothing to do. Just cancel out all the assets, liabilities, and equity. Then balance sheet of Z Limited after reconstruction will be only with the unit X. Okay. For unit X, net amount of PPE will be 50 and current assets 300, so 350. And equity share capital 50 plus 250, liabilities, current liability 50, so 350 will be. That's only X will remain. In the books of Q Limited, the acquirer here, PPE account and current assets are debited. Other equity is the balancing figure that is considered here. To borrowing, to current liabilities 390, current liability borrowing, and provision for depreciation. Other equity is being recognized here 150. You can see other equity 150 of the Z is now being considered as other equity in the books of Q. Then in the books of Q, the PPE will be 200, goodwill will be 10. The difference between purchase consideration and net assets, current assets will be 400 and total 610. Equity and liability, equity share capital only 10 will be considered as the one issue. Other equity preserved in the same form of the transfer or 150. Okay, so 150 in the same form we are preserving. Other equity was 150 negative. So in that negative form we are preserving it. Liabilities, borrowing 360, current liability 390 is there. Okay. Now goodwill is the excess of the amount recorded as share capital issued over share capital of the transferor. Share capital of the transferor and share capital issued. Okay. The difference between the two is being recorded as goodwill. So here goodwill is actually calculated as 10. Here is the consideration. You can see 10 is actually the consideration. And goodwill is actually here the difference between this assets debit, liabilities credit, and other equity also being considered or continued at the same manner. So the difference is considered as goodwill. So goodwill is 10. Finally, consideration is discharged with equity share capital. So equity share capital appears at 10. So in that way, in case of a demerger also under business combination under common control, keeping that in mind, demergers are recorded. Okay. So in today's discussion, we have covered a lot of topic under business combination. We started with the business combination, the definition, its objective, and tried to start our discussion with the acquisition method of accounting under business combination. We highlighted the situation of holding subsidiary relationship and how it is different from acquisition and merger. And then small examples we have considered with respect to this valuation of goodwill and recognition of assets and liabilities and goodwill in the books of the acquirer, uh, taking 100% subsidiaries, less than 100% subsidiaries, that is a situation of NCI, and also for takeover. And then we considered comprehensive problem on this consolidate on this business combination, uh, where in the first example we had not taken any intercompany adjustment or intercompany holding, while in the second and third example on comprehensive problem we considered that intercompany holding, where in the second example it was say the acquirer, that is good limited, having investment in having shares of bad limited already, and in the second case the acquiree having share of acquirer. Those two conditions or situations we have already considered, along with certain intercompany adjustments. Then we took two example rather on business combination achieved in stages. One comprehensive example, another small example we have taken. And for reverse acquisition also we have discussed the concept with the help of two illustration from the new study material. And then we finally concluded our discussion with that we came to the conclusion of our discussion with business combination under common control, where we took two particular example, one on amalgamation under common control, another one demerger under common control. Now, so this encompasses the entire issues under business combinations, and for the obviously for the examination purpose always you can expect one comprehensive problem from this chapter along with certain small numericals under MCQ. Okay. So that's all for today. Later let me hand over the session to the hosts. and stop sharing my presentation.
Abu sir, thank you.